Live.
Doing it live, yeah.
Jamming out there, Bill.
I am jamming out, man. Well, it's great music, man. This is a fantastic tune. It's amazing. You know, I mean, this is like you said, this is gonna be top 10 material here.
Think so.
I don't know
Happy
which
New
top
Year,
10 list
sir.
it's gonna be on, but you know.
Happy New Year to you.
Happy New Year. I know we're back. We're back and we're ready to rock and roll for 2026. It's gonna be a spectacular year. I'm feeling great about it. How about you, Craig?
Yeah, no, feeling really good. I mean, I think from the housing market, from the mortgage perspective in our business, we were probably twice as busy in this December as we were last December. And we probably have twice as many deals coming into the year as we had last year coming into the year.
Yeah.
So it's definitely much more encouraging of an environment from where we sit, in our world. And no, it's been certainly an interesting year,
No,
but
no. Listen, we finished very strong. I agree. I mean, December I was slammed. I'm busy right now, and I think part of it is I remember a year ago. I mean, rates were hovering around 7%, and right now rates are hovering like close to 6%.
that's right. I mean, we do a little blurb on interest rates and everything every week. And but this time, because the beginning of the year, we thought we would talk about, hey, what's the rate outlook for this year, what people are expecting, and maybe what people should potentially not expect. You know what I mean? And then we've had some
Yeah.
recent news.
Yes. Yes.
Trump has come out with some pointed things regarding institutional investment purchases, and then also having his agents buy $200 billion worth of mortgage-backed securities. So,
That's
we're going to
right.
get into them. We're
Those
going
are
to get into
two
that
big
too.
bullet points. Yeah, two huge bullet points. And you are on the South Florida Mortgage Report. Welcome. It's Billy May, your hat dude wearing mortgage guy, and Craig A. Garcia, president of Capital Partners Mortgage. Welcome to our podcast for 2026. We're worldwide now, baby. But we're going to focus
Yes.
on those two big topics in the news the past couple of days, Craig. Also, the jobs report this morning kind of had an influence on rates. But let's talk about the rate outlook for 2026 and what are we seeing or what are we thinking?
Yeah, and let me just do a screen share here for a second. Okay, so Bill, I got this slide up here, and so we'll start by talking about what happened in 2025, right? So
Right.
2025, we started the year 6.91%. By the end of the year, we left the year about 6.15% on the Freddie Mac weekly survey. So and 2025, from a stability of the market, of the interest rate market, was much, much more stable than it was the previous couple of years. Wild swings, a lot of rate increases, but last year was much quieter. And the trend was that it got better more often than anything else. So that was definitely very supportive. Now for 26, the prediction is kind of, a little bit more of the same. And so, Fannie Mae is predicting by the end of 26, that rates will be at 5.9%. That's about where we are now. The home builders are saying 6%, Mortgage Bankers Association 6.4, National Association of Realtors 6.1, Wells Fargo 6.2%. So by so that's for the end of 2026. So a lot more interest rate stability than what has been going on. Now, what are these predictions worth? It's pretty nobody's there. None of these guys are ever right on the money as far as predictions goes, right? I
Right.
think this was Fannie Mae's predictions versus what things normally were. So they were off a bit, and then except for 1 year they kind of nailed it on the head. But so the predictions are what they are. But I think the consensus is that nobody's expecting rates to go crazy high. Nobody's expecting
Right.
the bottom to fall out of rates, and we're not returning to 4% interest rates or anything like that this year.
Right.
Nobody's predicting that, which is interesting because there is some thought that there's going to be a new Fed president coming in, right?
Right.
Uh,
So we always the
new Fed
president always
chair, I
talks
should
about
say.
that, right? Yep.
Yeah, and so so the Fed chair situation, and I'm just going to stop sharing this. There we go. So Powell, he'll be in until May, right? And then and the market knows that there's going to be a new Fed chair, and the Fed chair is going to be picked by the administration. And everybody knows that the administration has been browbeating Powell about, lowering short-term rates a lot more. But yet the market is not, and even the Fed themselves, they're predicting that the short-term rates are going to be by the end of the year a quarter to 0.5% lower. Okay, where you would think, and there's certainly based off of what you've heard, some people in the administration say that that short-term rates should be much, much lower than where they are now. And
Right.
yet that's still even though we know they're going to be putting somebody in there that should be playing ball with them, there's still not this expectation of even the short-term rates getting lowered that much.
Yeah.
Why would that be?
Nothing drastic is coming down the pike from what we see. Yeah.
And there's a reason for that. And I think that, the insight to it is when the news hit about the idea that that Trump might fire Powell and put somebody else in there right away that would do his bidding, the
Right.
market definitely didn't like it. You know what I mean? And honestly, rates kind of got worse immediately upon the idea of that. And
Right.
the reason is that there's two things. A, I think the market definitely likes the idea of an independent Fed. But then B, if you lowered short-term interest rates a lot very quickly, what could that potentially lead to, you think? What did it lead to during COVID?
Well, I mean, the inflation. It's. I mean,
Inflation. And
and
the
look
infl
where we are today. Look at the prices of everything. That's definitely. And
so
that could affect
that's
mortgage rates. Look at since 2022, really mortgage rates. Really, it all started about January 2022 when we started having this, and boom, that's when, like you said, that's right when all that other stuff kicked in from that COVID spending from the federal government, driving up all these prices, and that's been 4 years now.
Yeah, no, that's so if the short-term rates were to get lowered a ton right away, then the irony is that mortgage rates and long-term rates could go up because those investors in those bonds, in those longer term investments, would be scared that this is going to be very inflationary action that's going to cause it, and they're going to not want to lock in on these, on their investments in these, at the rates now, if rates are going to
Right.
be higher later. And
Yeah.
so, yeah, so it could have the opposite effect. And so I think that's why, even in spite of this, this impending change to the Fed chair, that nobody's predicting, hey, a lot lower rates, even though they know that's what the administration wants, because, they're also predicting inflation's still going to be 3% or something like that. And so, it's it's probably going to be a stable year. They've actually got some of these predictions that rates are going to be really stable still, no big changes one way or the other, even through 27. Now,
Yeah.
who can predict 2 years out with any
Yeah.
bit of certainty? You know what I
Yeah.
mean?
We don't know what's gonna happen, and we don't, that's
No, no,
we don't even know who the Fed chair, for sure, gonna be, and then,
correct,
it
correct.
but we had stability this whole past year. Remember, at the beginning of the year, we thought there was gonna be this chaos and everything, especially with the president talking about, firing Powell and everything, but really, if you look at it, it was pretty stable, interest rates.
Yeah, no, that was, and then so yeah, so I think that if you're an agent or you happen to be a buyer and you're listening to this, I think this idea, that hey, super duper cheap rates are coming right around the corner, is probably not something that you're gonna see realized. And there's
Yeah,
nobody really
yeah.
predicting that.
I I don't foresee that happening, I don't know, ever again at 3 or 4%. We don't know if it's ever gonna happen, but that just yeah, like you said, they're predicting that within the next couple of years, are probably gonna be right around the 6% range. It'd be nicer to get down to, hey, lower fives would be great, you know what I mean? But,
And there's nothing saying that you're not going to have these ebbs and flows where, you're going to, some people might get lucky, you know what I mean?
right, right.
But some of that stuff might happen quickly. And, we're, we've got this other piece of this to talk about, but I do think that the in general, the message I think for 26 is, hey, this market's going to be again, the good part for buyers is it's a market that you could negotiate. You can negotiate with sellers. You know what I mean? And you can negotiate credits to buy your rate down, and you don't have to wait for
Absolutely.
the rates to come down if you get into a good situation on the negotiating side with your agent on the house that you want. Um, you don't have to wait. You can kind of make your market right now instead of waiting for the market to make you.
Yeah,
That's kind
yeah.
of
I mean,
nice.
listen, there's good inventory that's out there. I mean, I have a buyer went to contract this past week, and they're doing FHA loan, and they're asking for 5% seller concessions, and the seller agreed to it. And let's keep our fingers crossed and appraisal and everything. But it's out there. It is happening. But to get back to your point, kind of the things that what the president is talking about, he made a couple of big tweets this week. One was about the trying to bar these institutional investors, these big corporations from buying. Number one. Number two, he talked about, the profits of this $200 billion from Fannie and Freddie to go out there, and it's going to help, he wants to help bring mortgage rates down. So that's kind of interesting news that we heard yesterday and the day before, actually.
Yes. Yeah, no, for sure. And I think one is the first one, we actually talked about that on one of our calls, one of our podcasts, which was, the institutional buyers, you know what I mean? These big hedge funds that went out and bought properties. We saw a little bit of it down here after the housing crisis. And and then when we did some research at the time, it was the numbers that we saw were that, maybe 3 to 4% of all
Yeah.
homes nationwide were owned by some big institutional investor.
Yeah.
Um, and that there were some areas, 6, 7 big cities in the South, where they had come in and maybe they own 25% of the investment properties in some of these big cities in the South.
Right.
And those areas are probably is negatively impacting,
Right.
your minority, lower income buyers, unfortunately, um, you know, disproportionately. I don't know that the purchase appetite from those entities is still what it was back then.
Yeah.
I
It's
suspect not.
That's not going to fix the home affordability issue for the average first time home buyer right now. I think
No,
it's just
no,
something to make some headlines, get some tweets and likes and everything like that. It's really not going to be. But
yeah.
but what do you think
What
about the
I mean,
other one?
if it does do anything, it could be if there are some buying opportunities in some areas, and there are some kind of restrictions on these big institutions going in and competing with your first time home buyer type people, and it helps limit some of those situations. Hey, that could be a good thing, but it's probably not gonna, it's probably something that would have an impact if there's a nice um, break in affordability at some point. You know what I mean? That opens the doors to a lot of stuff.
Right.
Um, yeah, the other one's pretty interesting. And so this one said, Trump said, "Hey, I'm authorizing my agents to go out and purchase $200 billion worth of mortgage-backed securities." And his agents are Fannie Mae and Freddie Mac. Now, I had to brush up on this a little bit, but it is pretty interesting. Fannie and Freddie right now, they have about I believe combined $250 billion worth of mortgage-backed securities that they own that are like in their portfolio. Now they're involved in guaranteeing, trillions of dollars. You know what I mean? Like, the biggest, component of the whole mortgage segment in the United States. They're involved in the majority of it. But the ones that they own, it's about that. And this $200 billion is not a number he plucked out of the air. They're allowed, they're authorized based on the charter to purchase about $200 billion worth of mortgage-backed securities. And this is something that they have done in the past. They used to do it a lot. And what I thought was interesting was back before the housing crisis, they would do this a lot because it was like a profit center. They would, because they can borrow, Fannie and Freddie can borrow really cheaply. So if they were at that
Uh-huh.
time, they were borrowing cheap money, and then they were buying mortgage bonds that they were involved in issuing. So, you know what I mean? And then,
Right.
and so they had, so we're talking about now them having a total of, you know, $250 billion each or something like that. Back then, they had like $1.5 trillion worth of the stuff that they had bought, and and then after the housing crisis, it was determined, hey, that was a source of too much risk, and that's why they ratcheted that whole program down. So it's not like it's something brand spanking new, but it is a little bit more akin to that, and the purpose now is to try to bring down mortgage rates. And what I'm hearing from some of the experts on this is that um, it's a good thing, certainly not a bad thing.
Right.
It's not going to drive rates down, a really significant amount, but it is going to be something that is helpful rather than harmful. So that's a good thing, and it's funny. One of the ways they said that it might help is in bringing down the spread between the treasury, 10-year treasury, and the mortgage rates. And so that was
Yeah,
a spread which they
because
talked
that's
about in
been
the
something
past.
that's been like that for the past couple of years, and we've all been kind of scratching our head. Why is that? That would be positive. It does bring down that spread, then it could, obviously lower the mortgage rates. And if rates could get in the 5.5% range, there could be, and I did some reading, a lot of refinances actually, because there's a lot of people that don't want to refinance. But if they get down to 5.5 from 6.5 from the sevens, because a lot of people the past 4 years are over, they're near that 7% range. That could help us out
Oh,
massively.
well, one of our somebody that works with us is, has looked at it, and they're basically saving 1%. And sometimes you think, hey, 1% is not enough to make a savings, but on a enough of a loan balance, it certainly can be worthwhile. And so
Absolutely. Yeah.
that's how they're looking at it. And they bought a home in the last couple of years, and they had a rate in the upper sixes, and now they're getting a rate in the upper fives. There's a
Yeah.
way they can get it, and so that's very attractive. And so so yeah, no, it's yeah, and I think it's yeah, could you time it right perfectly? It's very hard to do that. You know what I mean? You're not
Right.
going to know. But I do think that if there's a lot of savings on the table, yeah, might be something worth considering rather than waiting to say, hey, I'm not going to do this until I get back in force. I don't know. Maybe you're not going to see that.
Yeah.
You know what I mean?
I
So
think
you
if we
never
could
know.
get below that 6% range, if we get below that, say, and getting those high fives, and there's going to be a stigma kind of attached to that. Hey, rates from the fives now that can help generate it. I think that's one of the things the president, from what I've read, they're trying to aiming for. And maybe this $200 billion purchase is trying to, hey, let's just kind of push us a little bit, get us down in there, and get some market noise going on for home buyers and maybe refinances.
Yeah, yeah. So and you know, immediately, just to follow up on the thing about the Trump announcement. Immediately following that, the bond market improved. I mean, mortgage rates got better. Now, it did say it has the potential to put a little bit of volatility in, which in other words, where rates get better and then they get worse, a little bit more quickly,
Right.
because now it's a little bit of a new thing, and people that are the investors are not quite sure what to make of it, and on what schedule this is going to happen, and you get people kind of trying to position themselves as quickly as possible to take advantage of any changes in this market expectation. So,
Right.
but the reaction was good. We had a jobs report today. Less jobs created than were expected. Unemployment rate a little bit lower than expected. So kind of a mixed bag.
Yeah.
In
I feel
terms of
like every time we
jobs.
have these reports, it's always a mixed bag. You know what I mean? It's always like, oh, the economy's not doing as good as we thought, but it's actually doing better than we thought. It's kind of like these,
Yeah,
there's more, I think what they said is like, well, a lot of these corporations are more profitable and so forth, and it's good for the investors and people who own stocks and everything, but maybe the average person doesn't, there's less jobs and so forth. It's just kind of interesting how they work.
correct. So, and again, probably for anything really meaningfully very different to happen in the mortgage situation probably means a pretty good deterioration in the jobs market, which obviously is kind of a weird thing to root for. You know what I mean? You don't, we're not, nobody wants to root for a lot of people losing their jobs. And then inflation's definitely got to stay down. So, yeah. So, we keep you informed here just of what's happening with these different market reports that come out. between the Fed meeting, the inflation reports, the jobs reports, the economy reports. That's what moves these rates on a regular basis, and
Yeah.
and the market
Well,
reacts how it does, and that's what we got to deal with.
well, 2026, like you were saying, from based on the data you have, all the reports are saying, hey, by the end of the year, it still should be around this, and it's going to be stable and everything. A lot of good stuff, I think. It's a lot of good stuff, and no market volatility. But we're seeing that hopefully rates will still be at the in the same where they are today, or maybe hopefully lower. That'd be great. I mean, we'd all love to have that, right?
It would be good. It would be good. So, have you made any New Year's resolutions, Bill, that
Oh,
you've already
I did,
broken, or
Craig, and he didn't really hold on to him very, 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 very quickly, so, but that's okay, so there's certain things I am trying to eat a little better like we all do, right? I'm doing better in that regard, but, I haven't got out there and started preparing for the marathon yet. Although I am getting ready for the DCC now. That is the Dolphins Cancer Challenge next month. I always ride in that. I've done it for about, I don't know, 8 of the past 9 years, and last year I rode, I think it was 39 miles. So that's gonna be coming up in late February. That is one of Yeah, that's one of those, resolution things that I am planning, to gear up more. So I'm getting. How about yourself? Did you think anything new going on? Any New Year's resolution?
I did not make any. I did not make any New Year's resolutions. I've just trying to trying to make good decisions. You know what I mean? And so
Yeah, yeah.
yeah. But nothing. Yeah, nothing that I put down that I said I really need to do this or that.
I
So
got you. I got
no.
you. Well, how about we shoot for 100,000 subscribers by the end of the year? That's what we should be shooting for.
Hey, there you go. There you go. We got some work to do.
Or we get to record another. We need to create a second song, to work towards our album, to accompany
That
Calculation
we can
Man.
definitely commit to. Yeah.
Yeah, yeah, yeah. I think we need to play the whole Calculation Man song at the end of this episode, so people know that you've worked so hard on this, Craig, and what you've done to create this music is just it's mind boggling.
Yes, yes. So I will. Yeah. So as we exit today, we will play for you in its entirety. If you decide you want to hang out and listen, you can hear the entire
Calculation
uh,
Man.
smash hit of Calculation Man.
I think
That's right.
I think it's awesome. So awesome. Well, listen, hats off to you. You have a great weekend. And we had the University of Miami had a big football win last night. They're going to be playing for the national championship against either Indiana or Oregon. In about a week and a half, I guess, right?
Well, I got to tell you, it was a fantastic game last night. I'm tired a little bit today because I have the sleeping habits of an old man,
Right.
and I stayed up to watch. But I will be rooting for Indiana because if you've got the Cuban quarterback and the against the Cuban coach for the national championship in Miami,
I agree.
I think they're gonna have to call it the Lechon Bowl. I think more pots and pans will be out celebrating than ever before in South Florida.
I
That'd be a good
agree.
thing for the community.
I totally agree. And but people don't know that the quarterback for Indiana, Carlos Mendoza, actually, I think it's Carlos Mendoza, right? Uh,
Fernando.
Fernando Mendoza actually is from South Florida, graduate of Christopher Columbus High School, very prestigious Catholic high school in South Florida. He was highly recruited by the University of Miami, by the way. His father played with the UM coach, Mario Cristobal, for UM. I guess I grew up with him back in the day. That's what I had read. I don't know if that's true or not,
I didn't
but
know that.
yeah, yeah, yeah. So it should be interesting. But Indiana's going to get through Oregon tonight, so we'll see what happens.
Yeah. Hopefully it's as good a game as last night. So anyway,
I agree.
um, good time. We will get together next week. And
Yes,
for everybody
sounds
there,
good. And as always, we will see you at the
closing table.
closing table. All right, let's hear that tune. I guess I keep recording. Jamming song. Jamming song. I guess we have to have some fun with it, right?
We did.